In Chapter 12, we move to look at intangible assets. And so we can see the main two characteristics is that those are long-term assets, they lack physical substance, but they're not a financial instrument, so they're not any of these particular things. At acquisition, we have two situations that occur. One is that we might just outright buy the intangible asset. The other one is that it might be internally developed. If we outright buy the intangible asset, all of these rules that you're going to see here are the exact same accounting rules we saw for buying property, plant, and equipment. So what I have here isn't any different. It's just that the kind of costs involved differ, because usually there's a purchase price, there might be legal fees, that sort of thing. But other than that, really, this is all the same sort of thing we saw with property, plant, and equipment. What's different is internally developing our intangible assets. And so we want to look at the accounting rules for that. Basically, if we develop our intangible assets, there's usually a lot of research and development involved. And so here's the accounting rule. The issue is that when the FASB deliberated this, their concern was that at the time the company spends money on research and development, the company doesn't know at that time whether those costs will have long-term benefit. It may be that some of the costs will lead to long-term benefit, but we don't really know. So since we don't know at the time, the FASB came up with this rule that we just expense everything. So all research and development costs, all of those are expensed at the time incurred. Even if we have a sense that, in the future it's likely 50% of these will lead to long-term benefit, even if we know it will likely have long-term benefit, we still expense it. There is one exception, and that is R&D expenditures for property, plant, and equipment that have alternative future uses, such as being used in other R&D projects or otherwise. So let's look at our research and development and go to our homework and see what's going on. Okay, so in exercise 1216, here we have a company from time to time embarks on a research program when a special project seems to offer possibilities. So in 2013, they spent $325,000 on a research project. By the end of 2013, it is impossible to determine whether any benefit will be derived from it. So what are we supposed to do with this $325? Well, that's pretty easy. We've already talked about that. If it's research and development, we expense it immediately. The other thing I would add to that, it's going to be included in the financial statements under operating expenses. It'll be under operating expenses, but we also will disclose R&D costs in the financial statements and the notes to the financial statements. So it's going to go on the income statement, but also there'll be a note in the financial statements about research and development. In Part B, we move to 2014 when the project is completed. We have a successful patent is obtained. The R&D cost to complete the project or $110. So here again, we have $110,000 of research and development. We expense that immediately. Doesn't matter if we know or don't know whether it has long-term benefits, we expense it. Now, the administrative and legal expenses incurred in obtaining the patent are $16,000. Now that $16,000 we will capitalize because that is no longer R&D. That's an intangible asset, and it's the cost of acquiring the intangible asset, so we capitalize that. And so the patent has an expected useful life of 5 years. So, we're going to take that $16,000, divide it over 5 years, and we will amortize that cost, $3,200. And so I just want to make a point here, and actually let me go back to my prior page. During the use, we will amortize the cost. Notice we are not going to have an accumulated amortization account. We won't accumulated depreciation. I do want to talk about cost allocation just real briefly. So to tie all of these last 3 chapters together, chapter 10, 11, and 12. We have different terms. We had the word depreciation, and we depreciate long-term physical assets. We also have the term amortization. We amortize intangible assets. And then thirdly, we deplete natural resources. But all three of those really mean the same. It's just taking the original cost of an asset and allocating it over its useful life. It's just applying it to different assets. Depreciate long-term physical assets, amortize long-term intangibles, and deplete natural resources. So over here, that's why we amortize the patent. And again, notice that we did not have an accumulated amortization account. We took it directly to the asset itself. Now I'm going to skip over. I'm going to post these two amounts to the patent account, and I've got a T account here on the next page. So let's post our $16,000, our original cost, and we just amortized $3,200 of that. Okay, so at the end of 2014, we have a balance of $12,800. All right, let's go on to the rest of the problem. In 2015, so we have 2013, we had 2014, and now we're moving on to the next year, 2015. The company successfully defends the patent and a cost of $47,200. So here again, what do we do with this cost? And just a refresher, remember in accounting, there's really only two ways an accountant will record costs. Either we capitalize a cost as an asset, or we expense it immediately. And again, this chapter is really driving this home, again, like many other chapters. So we had this cost of $47,200. Do we capitalize it as an asset, or do we expense it? Does it have long-term benefit? Right? Does it have long-term benefit or not? Well, this does have long-term benefit. We defended a patent that's going to secure, make us even more secure in that patent. And again, the FASB rules, cost spent on legally defending the patent, we capitalize those. So we're going to debit the patent itself for that particular cost, $47,200. Okay, so let's go ahead and post this over on NRT account. So now we have an updated balance of $60,000. Okay, that's 60 grand in there. Okay, and that took place in 2015. And that's going to extend the patent life to 2022. So now I need to think about, okay, how many years are left? We started out with a 5-year life, and we had 4 left at the beginning, and that was in 2014. So if we extend it to 2025, that's really going to be 8 more years. Okay, and so we can see, that's like 2015, just count them off. 15, 16, 17, 18, 19, 20. Oops, I messed up there, didn't I? I didn't get my 5. Let's start over. Let me erase that real quick. Okay, so let's start all over again. So 2015, 16, 17, 18, 19, 20, 21, 22. So there we go. There's our 8 years. And so we're going to take our 60,000. Let's refresh our memory. Oop, I see I erased that. Let me fix. Okay, so here we have it back. So all the transactions we posted up to this point, $60,000. So we have cost of $60,000, and we have that hasn't been amortized, and we want to divide that by 8 years, which is $7,500. So our dollar amount of our amortization expense is $7,500. So I just plug that in. We have another journal entry to the patent. Let's go over, post our $7,500 over here, and our ending balance then is $52,500 at the end. So there's what we end up in the patent. Okay, so we finished that one. I also want you to take a look at exercise 17. In here there's a whole bunch of different kind of costs. And again, the big issue is, if we have cost, do we capitalize that as an asset, or should these costs be expensed? And theoretically, The big question is, if there's long-term benefit or not. But again, there's kind of an exception to this rule. The FASB just blanketing said, any R&D costs, we just expense that right away. But there is the exception to that R&D cost, and let's go back and take a peek at that. The exception is if they have alternative future uses, and it's a long-term long-term expenditure, not expense, but expenditure. So here we have equipment, and it tells us it's going to have alternative future uses. So that would be capitalized as an asset. Let me put it over here. So we would initially record that $280,000, capitalize it as an asset. But then for R&D expense, we're going to divide that by 5 years and get $56,000 as part of R&D expense. So if I list that R&D expense, these materials consumed would also be a part of R&D expense. So it would be consulting fees of $100,000. Those get expensed as research and development. Personnel costs, that's also R&D expense. Indirect costs, it's on R&D expense. The last one here, they've been purchased, but it's for future use. So they haven't been used yet. So we would actually categorize this as a short-term asset. Something like supplies, the supplies account, it would be akin to that because we'll expense it next year. So if I add all of these expenses up for R&D, we're going to get something like $393,000 as our R&D expense. All right, let's keep going. Problem 4. 2012, we've got a company purchasing a building site for using, proposed R&D laboratory at a cost of $60,000. So, we have land being purchased, $60,000. So do we capitalize that as land or do we expense it? Well, it's a long-term asset and it has alternative uses in the future, so we're going to capitalize that $60,000 as an asset. Construction of the building was started in 2012 and completed at the end of 2013 at a cost of $320,000. So do we capitalize this cost or expense it? Well, we should capitalize it because it has alternative future uses. So even though it's used for R&D, it has alternative, it's going to be used for lots and lots of different R&D projects, so we want to capitalize it. Okay, so it was put in place, at the end of December, so really the beginning of 2014, right? Okay, so we have all of that taking place. And let's see, what else do we have? Depreciation is going to be over 20 years, so I might make a note. This is a 20-year asset, so we don't forget that. Okay, so let's go on to the second paragraph. Management estimates that 50% of the projects from this R&D development group will result in long-term benefits. Now that's interesting information, and we certainly would hope that a company is going to get some long-term benefit out of their R&D costs. But let me ask you this. What impact does this have on the accountant? I mean, certainly as accountants, we want to know there's going to get some return on our investments in R&D. But in terms of reporting the R&D costs, what difference does it make to know this? Well, I hope that you recognize none. Because again, the FASB has ruled, even if we estimate, this 50% is going to lead to long-term benefit, it doesn't matter. All research and development is expensed, except for these long-term physical assets like this that have other future uses. So we're going to expense this cost, it doesn't matter. So we have these remaining projects, and it kind of goes on, and then, it gives us the schedule for 2014. So in 2014, the company had all of these costs. So look at these. Here's salaries and benefits. They're going to total, $195,000. Here's other expenses, and those are going to total $77,000. So we want to look to see, should we capitalize any of these costs? So this is R&D. Do any of these meet the exception to capitalize them? So stop and think about that. What about completed projects with long-term benefits? Expense it or capitalize it? Well, it's going to get expensed. It doesn't matter that it had long-term benefits. It's research and development. It's not buying something like this with alternative future uses. So really, all of these abandoned projects, projects in process, it doesn't matter whether we could discern whether it would or would not have long-term benefit. All of this is going to be expensed. So let's drop down here and arrive at for 2014. For 2014, what will be our R&D expense? Well, we've got salaries over here. The total $195,000. So that, we've also got this other of $77,000. And then there's one other that's going to count for research and development. Do you recognize it? Stop and think about it. It's going to be connected to these two. That's right, the building. We're going to allocate that building over its 20 years. And so depreciation expense related to the building. So depreciation, if I can squeeze that in. 320 divided by 20 is going to be 16,000. 288,000 will be our research and development expense for 2014. Okay, and I'm going to go ahead, since we know that's an expense, let's go to the next page where I have, you know what we're to do for 2014, figure out what's going to go on the income statement and what goes on the balance sheet. Well, we just figured out research and development expense for 2014 is $288,000. Okay. Okay, and by the way, all right, so let's go on. What else do we know? Upon recommendation, the R&D group acquired a patent for $88,000. So what do we do with that $88,000? Well, it's a cost of the patent, isn't it? And that is an intangible asset. So that's a cost of an intangible asset. And then that was purchased on April 1, 2013 with an economic life of 10 years. So we got a couple of things going on. Let's go ahead and figure out our income statement. Again, income statement for 2014. Now for our income statement on 2014, we're going to divide this by 10 years and we will get amortization expense. So we're going to amortize that $8,800. So let's go over and put patent amortization expense. So we'll have amortization expense. Amortization expense of $8,800. Okay, so we've finished the income statement. R&D expense, which included depreciation, and then amortization expense for the patent. And the amortization was not part of R&D because patents are not part of research and development. Okay, going to the balance sheet. Well, let's look at what we have. We have three assets, don't we? Land, building, and patent. So let's go put those three on our balance sheet. Land, building, and patent. Well, the building doesn't get depreciated, so I'm just going to report it at its original cost, $60,000. But however, the building depreciates, and I'll just tell you, for Wiley Plus, that solution is not looking for the $320,000. It wants the $320,000 less accumulated depreciation. And just a reminder, let's see, the building was completed at the end of 2013. So we would have, for 2014, there's only been 1 year of depreciation expense, hasn't there? So we have a building with a cost of $320,000, and we only had 1 year's depreciation. So we would subtract $16,000, which is in accumulated depreciation, right? We debited depreciation expense. Actually, we debited R&D expense, and credit accumulated depreciation, giving us a net $304,000. Again, there was only 1 year. Now the patent is a little bit harder to get at. The patent was acquired April 1, 2013. So let's kind of look at that a little bit. Actually, I have a little bit more space over here. Let's kind of look at that. So we have the patent, $88,000. And we divide by 10 years. So the annual amortization is $8,800. Now, for 2013, again, remember they bought this on 4/1/2013. So April through December is 9 out of 12 months. So for 2013, $6,600 was the amortization. Then 2014, they would have got the full amortization of $8,800. Follow? So we only amortized 9 months out of 12 for 2013, but we would have amortized the full $8,800. And again, you're debiting amortization expense, crediting the patent. So the patent started at $88,000, but then we reduced it $6,600 in 2013 and another $8,800 in 2014 for amortization. And that gives us an ending balance of $72,600. Okay, so that's a good application of intangible assets, how that impacts the income statement, and how it impacts the balance sheet. All right, next one, and this is the last one for this particular recording. All right, so we have Sandra Corporation, January 1, they signed an agreement for a franchise for $75,000. Of this amount, they pay $15,000 right now, and then they agree to pay, $15,000 over the next 4 years at the beginning of each year. We have a 14% rate, and then they give us this present value here. Okay, well, let's actually look at, and I'm just going to draw it here, the time chart. We have year 1, 2, 3, 4, and 5. And what's happening is that the company's paying out $15,000 now and at the very beginning of each year. So $15,000 at the beginning of each year. Oop. 1, 2, 3, 4. I did that. I almost did too many, didn't I? There's only 5 payments. So beginning of year 2, beginning of year 3, beginning of year 4, beginning of year 5. Okay, and if you were to use your calculators, I mean, N is 5. They give us the interest rate up earlier. Here we go, 14%. We know the payments are $15,000. Now, this is annuity due. The payments at the beginning of the period, making it an annuity due. So change your calculators from the end of the period to the beginning of the period. And make that change, and if you do that, you should get a present value of something like $58,706. $58,706. Okay, and that's with your calculator. And again, you need to change that from the end to the beginning. Okay, well, the problem didn't really make us use our calculators. It really gave us the information already, and it did it this way. It told us these 4 numbers. It gave us the present value of those and said, well, the present value of those 4 is $43,700. So if we add these 2 together, here's today, right? Here we are today. We pay $15,000, and in the future we're going to pay these 15, but If I discount those 4 back to today, they're worth $43,700. If I add those together, I will get $58,700 as our total present value. Now, $58,700 is different by $6 over here, and it's just rounding. The calculator is more accurate. Your author of this problem used the tables. The tables round, so that's why we're off by $6. But on the upside, you don't have to use your calculators or the homework. It just gives you the number. But I did want to go over this, and feel free to try out your calculator and the homework and see if you get within a few dollars, because it's just fun and interesting to know how to do that. Okay, so we have the franchise. So the franchise itself has a cost of $58,700. And you know, so we would debit the franchise, $58,700. Actually, let's go over that journal entry. So we would debit the franchise. Hang on a minute. Don't have that much space, so I want to be careful with it. So our journal entry, if we want to write it out, would be to debit the franchise, $58,700. Cash gets paid, so cash will go out. $15,000, and then what? What else are we giving up? So we give up cash today. We also give up, you know, something worth $43,700. And what is that thing? Well, it's some sort of liability, right? And it's a note. It's a note payable. The present value of that note payable. Okay, so we have this franchise, and so we have that particular cost. And so we can see we have a cost going into the asset, $58,700. We also then, if we think about, you know, what other costs are going to be involved, that all happened on January 1. If you think about it, then at the end of the year, we're going to amortize this, right? So we've got the franchise going up. We also have amortization expense related to it. Just going to abbreviate amortization. And let's see. It's estimated to, we're going to use it 10 years, so divide by 10 years, so 5870. And then we would reduce the franchise directly. We don't have a contra account, like accumulated amortization. So we've posted this. Let's go post this 5870 over there. Okay, so we reduce our franchise for the amortization expense. What else do we have? Well, they also tell us that we have to pay 5% of revenues to our franchisor. So we had revenues of $900,000. So we're going to have a franchise fee, $900,000. That if not, we don't have to pay that over. But 5% of that, which is $45,000. Now, do I expense that, or is that an asset? You recognize that was just a cost for this period, so it's an expense. So we've had the cost for the franchise, we've had the cost for amortization expense, and now we have the cost of this fee. So we've had one asset, and we've capitalized the two expenses. Now there's one other cost related to this franchise. Do you recognize what it is? I mean, there's really nothing else here in the narrative that's going to tell us anything. So what else do you see here that creates another cost for us because of these transactions? Well, I hope you recognize it's this note payable. If we borrow money, we owe interest. So we're going to have interest expense. So let's see, $43,700 is essentially what we borrowed. That's the value today, and at 14% for a whole year. So that's going to be $6,118, and again, that's going to be interest expense. So let's go over, really what they want us to do is figure out, what do we do with all of these costs. So now that we figured out the franchise, let's go put these things where they belong. The asset belongs on the on the balance sheet. And before we move over, let's tally what that's going to be. The franchise will have an ending balance at the end of the year of $52,830. So we want to take that forward to the balance sheet. let me just erase this. Even though it does go on the balance sheet, it's going to be this ending number that will go there. And then all of these other expenses, right? All of these other expenses will go on the income statement. So let's go to our financial statements and take these three numbers to our financial statements. Okay, so for intangible assets, we have the franchise. And it has an ending balance of $52,830. Then for the income statement, we had franchise amortization expense. I'm just going to abbreviate that. And that was $5,870. We also had the franchise fee. Again, that was an expense. And that was $45,000. And then we had interest expense related to the note. And that was the $6,118. Okay, so there's everything with the franchise. Now let's go back and look at B, and go ahead and look at B. So on B, we have some $65,000 of experimental costs, and then the patent was granted on January 2, 2014. Okay, this $65,000, how was that accounted for? Well, let's go over here. You know what? I don't know where that line came from, but it seemed to have just printed out here, so we're just going to have to ignore it. The $65,000 was R&D expense. So there's no trick. That's not a trick question or trick issue at all. Actually, what's tricky about it on this problem is figuring out, well, when did this cost take place? The $65,000 actually took place before 2014. Well, if we're writing out the balance sheet and the income statement for 2014, then this isn't going to be relevant, is it? So this all happened before 2014. So we're not going to factor that in what we write on the balance sheet or the income statement for this. Okay, so the rest of what was going on, they paid legal fees and other costs, $17,600. You know, all of that is the cost of the patent, so we capitalize that, and then we amortize it over its 8 years. So let's just quickly go do that. So we're going to have a patent with a cost of $17,600 going in. And then we want to take that cost and amortize it over 8 years. So we get amortization expense annually of $2,200. So we debit amortization expense, credit the patent. Debit the expense, credit the patent. We'll have an ending balance, $15,400. So we have this expense on the income statement for amortization expense. And when we go to the balance sheet, here's the value of our asset. Okay, so we have a, didn't get to the black. So here's our patent. And it has a value, accounting value of $15,400. And then down here we had the patent amortization expense. I'm just going to abbreviate that and stop. So the patent amortization expense was $2,200. Okay, last one, C. So on C, we have a trademark for $36,000, and this took place on July 1 of 2011. Okay, so this one's going to be a little more complicated because it starts way back when. So we have a cost coming in, $36,000 for a trademark, and it's significant because that happened on July 1, 2011. Okay, so now we have to think about, we had that cost, $36,000. In the narrative, it's going to tell us that the life is, oh, here, let me erase some of this so you can see it on the screen. Okay, so we have a life of this particular one for 20 years. Okay, so if we divide that by 20 years, we'll get annual depreciation expense to be $1,800 annually. Oops, sorry about that. Okay, now in 2011, they only held the asset half a year. So instead of a full year, they'll only get half a year's amortization. So at the end of 2011, we have a balance of $35,100. Okay, and then that was for 2011. 2012, 2013 would go by. Now both of those years, 2012 and 2013, would get a full year amortization. Okay, so now our balance will be $31,500. And that's going to be on January 1, 2014, right? After 2013, at the beginning of 14, here's our balance. Okay, so we have a balance of $31,500. Now let's go to the narrative and see what else happens. Now, in the middle of 2014, they successfully defend the trademark. Well, any legal, if you successfully defend your trademark, you're adding value, and it's really common, and I probably should have talked about this earlier, but since I didn't, let me do that now. Trademarks, patents, copyrights, lawsuits are all over the place on these things. I mean, these are things that have real value for companies. 30 years ago, if you were to look at a company's balance sheet, there wouldn't have been that large of intangible assets. But as we have grown and grown into more reliance on what I'll call intellectual property, there's, the dollar amount of intangible assets has grown tremendously for corporations. So intangible assets have become a significant part of the balance sheet for many, many corporations. So they have real value. And so typically then, a corporation may inadvertently step on somebody's toes by trying to, trademark something that another corporation's already using. Or maybe another corporation is just accusing, a company of stealing their trademark. So anyhow, lots of lawsuits, so it's common to have to defend it. And if you defend it successfully, then that just strengthens the value of the trademark or copyright or patent or whatever it is. So it brings real value to the company. So successfully defending it adds value. So that $10,200 is going to increase the value of this trademark, and we will capitalize it. Now I'm going to put it down here because, actually I don't want to put it there yet. Let me hold off on that. Okay, so we do know we're going to capitalize that cost, but that's going to happen in the middle of the year. So because of that, we're going to go ahead and record half a year's amortization, almost caught myself there, for 2014. So before we capitalize that, we're going to have a balance now of $30,600 in this account, and that's going to be on January 1, 14. So in January 1, 14, we have a balance of $30,600. Now, the company spends $10,200 on a lawsuit adding value. So now the balance is $40,800. Okay, and now I got to figure out, okay, I want to amortize that $40,800, and how many years are left? So let's go over here. At that point in time, how many years have we already amortized? Well, here's half, so half. Here's 2, so 2.5, and another half makes 3. So we've already amortized, at January 1, 2014, we've already amortized 3 years. So that means if it's got a 20-year life, 17 years are left. So now the annual amortization going forward is going to be $2,400 annually. All right, now for this particular company, for 2014, we only need half of that for this year. So we're going to amortize $1,200 half a year. Okay, so we would debit amortization expense, credit the trademark, $1,200. Okay, so now 40,800 minus 1,200, our final ending balance, 39,600. Okay, so this was a little complicated because it all started, the acquisition started in the middle of the year, but at the same time, the author of this case made it also kind of nice and easy because it just happened to be that this other 10,200 also took place on January 1. So it was complicated, but then they kind of made it easy. Okay, let's go forward. What are we going to see on the financial statements? Well, this unamortized cost goes on the balance sheet, and then the amortization expense. Well, we have $900 and $1,200, so $2,100 total for 2014 will be our amortization expense. Okay, let's go forward and do that. So asset, trademark, 39,600. And then lastly, we'll have trademark amortization. I'm just going to abbreviate that. Trademark amortization, and that was at $2,100. And then Wiley Plus is going to ask you to total all of it. And if you total all of it, in this case, $61,288. Okay? So that's the end. Again, and the one thing I liked about these problems was that it made you discern what goes on the balance sheet, what goes on the income statement. Okay, so in this lecture, we have gone over most of the issues related to intangible assets. We've gone through acquisition when we buy it, again, purchase price, legal fees, that sort of thing. We really didn't have an exchange for it, but that's there, just the theory's there for your notes. We've gone over internally developed, what to do with research and development. During the use, do we capitalize it? Or expense it, and usually cost of successful, again it has to be successful, defense. So legal costs for successfully defending an intangible asset, we capitalize that as an asset. We amortize it over the asset's useful life. Now we always saw in all of the homework, it was a limited life asset. If it had an indefinite life, we would not amortize it. Like that would be similar to land. We don't depreciate land because it has an indefinite life. Any intangible that has an indefinite life also would not be amortized. The one thing we did not get to or discuss on this recording is impairments, and that'll be the second lecture.